Right, welcome to Lecture 3-A. Before we begin with the lecture, let's do a quick review from Chapter 2. What is a trial balance and what the heck use is it? Well, it is a listing. A list of all accounts and their balances. That's what it is. What use is it? Well, it's used to confirm that debits equal credits, primarily. Okay, what is revenue? Very important. Revenue is an increase in owner's equity resulting from the sale of goods or performing services. Okay, it's not the same thing as cash coming in or account receivable. It's what happens to owner's equity. So it's an increase in owner's equity. And contrast that with what is expense. Well, expense is going to be a decrease in owner's equity, which comes from the costs incurred in order to earn revenue. Okay? All right, so today we will look at accrual accounting, revenue and expense recognition, and adjusting entries. So, what is accrual accounting? Well, it's best illustrated with some examples. So, I am a landlord, and as a landlord, I collect rent from tenants, typically on a monthly basis. However, imagine that a tenant pays me for the December, January, and February rent all in one lump sum on the 1st of December, okay, in 2011. So when I make up my income statement, which reports all my revenue and all my expenses for a certain time period, so when I prepare my income statement for 2011, for the year ended December 31st, 2011, should the revenue that I report include this payment? Well, it should, but only partly. So it should only count 1/3 of it. December's rent. December falls in 2011. January and February do not, and that revenue should be counted in the next year once it's earned. So at the end of December, I haven't earned January, February. I mean, let's ignore the legislation for a second. If the tenant moved out on January 1st, I would owe them back that their money that they had paid in advance, right? So I can't count that as revenue at that point in time because I haven't earned it. I only earn it by providing shelter to the tenant over the period of time. So that is what accrual accounting is all about, recognizing income, revenue, and expenses in the appropriate time period, not when cash changes hands. Cash basis accounting records transactions only when cash actually changes hands. So from a cash basis standpoint, I would record all of that revenue on the 1st of December. Clearly, there are some weaknesses with cash basis accounting. Its one great advantage is that it is simple and easy to use, and therefore kids running a lemonade stand can be forgiven for using cash basis accounting. We, however, will not, and therefore do not ever in this class use cash basis accounting. So, and the reasons are replete, right? Revenue Canada requires it for taxation. It provides more useful information, and so on. It is the common global standard on how to account for business transactions. Now, 3 concepts are fundamental to accrual accounting. They are come on, highlighter. There we go. The accounting period, recognition criteria for revenues and expenses, and the time period assumption. Okay, so the accounting period basically says that although we assume that businesses will kind of operate indefinitely, we chunk time into periods during which we report financial information. And most businesses do that on an annual basis, right? So at the end of that time, a business measures and reports its income. Some businesses use the calendar year. Other businesses use what's called a fiscal year, which is simply a 12-month period that can end any time in the year, right? So a business that I own has a year end of June 30th. And it just works out best for me to do it like that. So my end of the year, with all my balance sheet, financial statements, all that kind of stuff, I produce them as of the end of the year, or the end of the month, June 30th in the year. And I file taxes and everything else at that point in time. So for us as individuals, Revenue Canada requires that our year end is December 31st, right? So when you pay tax, it's always on the calendar year. But businesses have the flexibility to choose their own year end. And occasionally you can change it if there's good reasons, but basically once you pick a year end, you're stuck with it. So every 12 months thereafter, you use that. Okay, next, the recognition criteria. So if we're using accrual accounting and not cash basis, then we can't use the changing hands of cash to be what defines when revenue takes place or when expenses are incurred. So what we actually do is we use the recognition criteria that states for revenue, revenues get recorded when they are earned. So when the good bought or sold changes hands, or when a service has been performed. And along with that is how much revenue do you record. It's fairly obvious in just about all cases, but in those couple of ambiguous cases, it will simply be the cash value of the goods or services that are transferred to the customer or client. Okay? So if you're struggling with this concept of revenue recognition, you can read the little example of Dr. House and when he performed his surgeries and when he got paid and so on. Obviously, it's an American textbook, so you see the billing happening and so on as per. But we won't fuss too much with that. Now, looking at recognition for expenses, we have the matching objective, which basically states that all the expenses that we incur should be recorded in the accounting period where they were incurred in order to generate revenue. So they should be matched up with the revenues. If we're reporting revenues being earned in a certain point in time, then the expenses that were incurred to earn those revenues should also be reported during that period. Okay? Some of them are easy to kind of link up. So the easiest one, for example, would be sales commissions, right? The sale happens, the commission happens. They would be linked, obviously. Others are a little bit less direct, that link. So rent of the store rent. Well, we would still look at the time period for which the rent was paid would be matched against the revenue earned in that time period. All right. And then the final assumption that we're going to look at here is the time period assumption, which ensures that accounting information gets reported at regular intervals. Okay, so not just once a year, or at a minimum once a year, and sometimes on an interim basis more frequently than that. So let's do a little example here. Sports Unlimited sells annual subscriptions for 12 months worth of magazines that they mail to customers each year. Company collects cash in advance, then mails out the magazines to subscribers. Suppose the company collected $80,000 for subscriptions for a calendar year. apply the recognition criteria to determine, number one, when they should record the revenue, and two, the amount of revenue they should record for the January through March mailings. Well, they should record the revenue when? They should record 1/12 of the total each month. After the magazine is mailed to customers. Is mailed out. Okay? Number two, how much revenue should they recognize for January through March? Well, let's see. January, February, March. 3 months, right? So we had the full amount for a year of $80,000 divided by 12 months times 3 months gives us $20,000. So that's the amount that they should record for that 3-month period. Okay, so because of these concepts where we don't just look at when cash changes hands, we look at when things ought to be reported, when they're incurred, when revenue is earned, and so on. We have to now do some special journal entries to adjust our balances in the trial balance at the end of an accounting period so that our financial statements accurately report what's going on. Okay? So, these adjusting entries take several forms. And in a nutshell, what they do is they assign revenues to the period in which they're earned and expenses to the period in which they're incurred. And we make them really because we are about to produce financial statements and we want to make sure that the information that we report in the financial statements is accurate. Now, these can be divided into two broad categories. Okay, so a prepaid adjustment is needed when cash happens before the expense or revenue, and an accrual happens when cash changes hands after the expense or the revenue. And so some examples of these follow on the next page. Right? So this great big chart here, a prepaid expense. The classic one is insurance. You pay for insurance at the beginning of the year, like you pay car insurance, whatever, for the year, but you don't actually use it up until the entire year goes by, right? So every month you use up a little bit more and so on. So we would do a couple of entries. The entry to set it up, and then as time goes by, you actually convert that prepaid expense, that prepaid insurance, which is an asset, it gets gradually converted into insurance expense, and so on. So you can come back and look at these tables. We're going to look at these in detail right now. So 5 broad categories. Okay, so we talked about prepaids and accruals. More detail now. We have prepaid expenses, we have amortization, we have accrued expenses, accrued revenues, and unearned revenues. So, prepaid expenses requires the adjustment because the cash is paid in one period, but the resource is not completely used until a later period. So if it was a cash basis, we would, have our entry all set up. But because of accrual accounting, we pay cash for insurance. As I said, right? Pay cash for insurance. We don't actually record insurance as an expense because we haven't, insurance is coverage over a period of time. The day we buy it, we haven't used it up yet, hardly at all, right? And so we're setting it up, the transaction when we buy insurance, we set up an account called prepaid insurance, and that's where we debit the transaction to, and then every month or every time that we're going to report, we do an adjusting entry that takes that reduces this prepaid insurance by crediting and converts that prepaid to the actual amount of insurance expense that's incurred by debiting that. All right. So if we report on a monthly basis, we'll do this monthly. If it's annually, we'll do it only at the end of the year and zero it out. And we'll continue this in part 2 of the lecture.